Good afternoon. With consideration to the Reserve Bank's policy target agreements, the Reserve Bank of New Zealand has today decided to leave the official cash rate unchanged at 1.75%. We've considered the inflationary outlook for New Zealand through analysing forecasts for domestic demand, international demand and supply side conditions.
Domestic demand conditions. The GDP growth of New Zealand is currently at approximately 3%, but estimated to slow down to 2 to 2.5% in the medium term. Further growth is expected to take place in the medium term due to a large increase in capital expenditure in the 2017 budget from 1.4 to 4 billion, the largest increase in decades. The heavy traffic index is projected along a steadily increasing trend. The household consumption has increased due to the wealth effect, with income growth fueling it. Consumers perceive themselves as richer and thus spend more. The forecasted real household consumption growth is projected at 3.6% for 2017 and 3.2% for 2018. This is an inflationary pressure. Adjustments to tax brackets in the new budget allow for people to have more disposable income, which will act as an inflationary pressure by increasing aggregate demand. The unsolved construction market issue stemming from the lack of trainees and workers is evident from the housing shortages in most major cities. Following significant natural disasters, the construction sector has focused on reinforcement and repair, further straining the household construction market. This is an inflationary pressure.
House prices are easing from the stricter LVR and increasing mortgage rates, resulting in affordability constraints. Construction is also set to increase from the finalisation of the Auckland Unitary Plan, thus acting as a deflationary factor. Following the housing market, the cost of rentals have increased. A large proportion of the population has become dependent on the rental market, causing prices to spike. Landlords are also likely increasing rent as per rising CVs, thus the rental market is a strong inflationary factor. Visitor numbers and their average spending continue to increase due to the weakening New Zealand dollar. Continued investment into this sector has led to more visitors worldwide. Tourism spikes will occur from key events being held in New Zealand, such as the Lions Tour, to act as inflationary pressures. Net migration is increasing at a slowing rate, which has been spurred by the turbulent global political environment. The recent cuts in the Australian budget have incentivised more Kiwis to return home. Additionally, recent changes in immigration laws will mean there is a higher ratio of skilled workers, contributing more to aggregate supply, hence as a deflationary factor. Overall, domestic demand conditions are inflationary due to the increasing house and rental prices from the consequences of the limited construction market, as well as increasing numbers entering the country.
International demand conditions. Global growth has taken a hard hit last year with our trading partners' growth down to 3.2%, but it is expected to recover this year from a manufacturing, trade, and investment rebound. Despite the uncertainty in the US and gradual slowdown in China's economic growth, China's growth stood at 6.9% in the first quarter, due to increased investment, credits, and exports. Rising economic growth in both the US and Australia are due to increasing oil prices and commodity prices respectively. Together, this results in increased New Zealand export demand from our major trading partners, which act as a moderate inflationary pressure. Dairy prices are slowly increasing and are expected to continue to recover, although there remain uncertainties in both global supply and demand. Since dairy is one of New Zealand's key export industries and we're a trade-oriented economy, this is a slight inflationary pressure as it increases slowly. There are positive market conditions for commodities, especially with dairy prices recovering. The increase in demand from China is supporting these positive conditions. Horticulture is performing strongly, with kiwi fruit exporters benefiting from productivity growth and product innovation, which is increasing demand in Asia. This is a moderate inflationary pressure. The New Zealand exchange rate is still overvalued relative to the conditions in New Zealand because of low global interest rates relative to ours. This reduces capacity pressures by causing exports to be less price competitive, and with low global inflation dampens tradable inflation. However, with uncertainty in the US trade protectionism in dairy with Canada, the NZD has fallen recently. This is a strong disinflationary pressure in the short term. With increased speculation in the federal funds rate, as well as promising signs for the US economy, the Federal Reserve is signaling more rate hikes this year, which may depreciate the NZD. However, this is offset by the USD depreciating this year because of unclear policy developments there, allowing the NZD to pick up near last year's level. International demand conditions are looking better with the recovery in the global economy, coupled with dairy prices increasing and positive market conditions in other exports. The exchange rate is overvalued, but the coming hikes in the Fed funds rate and the uncertainties may depreciate the NZD. Overall, we're seeing inflationary pressures.
Supply side conditions. Unemployment rate has decreased since the 2009 financial crisis. We predict that this trend will slow. Unemployment rate is going to decrease just at a slower rate to around Nauru of 4 to 5%. This means unemployment rate is currently neither an inflationary nor a deflationary pressure in the medium term. Wage growth. Adjusted for inflation, wage growth is stabilizing around 1.5 to 1.8% and will remain subdued in the medium term, such as below historical trends, and thus will allow businesses to grow and meet increasing demand without increasing prices. As such, this is a moderate deflationary pressure. Although oil prices have become less expensive in the recent past, the US EIA forecasts a moderate rise in oil prices in the medium term, up from $51 in 2017 to 58 USD by 2019. This is due to a decrease in supply from OPEC countries. This, combined with prospects of further depreciation of the New Zealand dollar, increases cost and decreases spare capacity, and this is a strong inflationary pressure. Decreasing labour productivity in recent years is due to strong labour market growth and low annual output growth, as aggregate supply due to labour is increasing proportionally less than aggregate demand from increased consumer expenditure. This results in a higher AD relative to AS and inflationary pressure. Business confidence remains low compared to historical trends. Only a net 11% of businesses are optimistic about the business environment in the medium term. A net 30% of businesses expect it to get harder to obtain credit for the next 12 months. This means businesses are less likely to hire and invest, a deflationary pressure. Overall, there is a mild inflationary pressure regarding supply side conditions.
Inflationary outlook and risk. Inflationary outlook. Looking at the current conditions of the economy, the Reserve Bank has thus decided to leave the OCR at 1.75%, considering the moderate and mild inflationary pressures that will be elaborated further. There is strong domestic demand, recovering international demand, and spare capacity tightening. Monetary policy decision analysis. Inflation in the medium term would remain in the target band of 1 to 3%, just below the midpoint of 2%, taking into account the effect of the transmission lag of monetary policy. Non-tradables inflation is continuing to rise, while tradables inflation would be moderated in the medium term. Currently, headline inflation is sitting in 2.2%, with tradables inflation spiking at 1.6%, contributing to the rise of headline inflation, and non-tradables at 2.5%. Core inflation remains low. Output gap. New Zealand is currently operating in a small positive output gap. This means that actual output is above potential output, hence causing inflationary pressure. This is from growth in tourism and construction causing capacity pressures. OCR decision evaluation. The recent spike in headline inflation has been mainly due to the volatility of the food prices early this year from bad weather, which caused shortages of fruits and vegetables. Further headline inflation is also expected to remain at around 2%. Core inflation is around 1.5 to 2%. Oil prices also contributed to this increase with the restriction of supply from the OECD and one-off tax increases in tobacco. This would drop out of the calculation later in the year, so inflation would stabilise. Therefore, increasing the OCR at this time may undermine growth by keeping inflation subdued and below the target band. Decreasing the OCR would cause more inflationary pressures that are not necessary. Therefore, despite inflationary pressures coming in from the economy, we will keep the OCR constant to accommodate to inflation that will only be temporary. Additionally, with political uncertainty, there are risks with consumer and business confidence and investment uncertainty with changing the OCR. Key assumptions and risk. The key assumptions in our analysis are highlighted here. If these assumptions are not realised, deflationary pressures will keep inflation subdued and the housing market would cause financial instability. The easing of monetary policy may be required. This concludes our analysis on our decision to leave the OCR unchanged at 1.75%. Thank you.
Great, thank you very much. You all presented really well and did a really good job taking on the feedback that we gave you on the island presentations. Made a really good presentation. We're now going to jump into some Q&As, and we'll start with, the tax on tobacco is scheduled to increase by 10% on the 1st of January every year from 2017 to 2020. How does this impact inflation, and how should the Reserve Bank respond?
Should I start off? So I think this will definitely affect inflation because demand for tobacco is relatively inelastic. So I think that would increase aggregate demand.
Yep. Do you have anything to add?
So it will affect inflation, but it would just be a one-off increase every year.
But because it's affecting us in the next like 4 years, that's probably within the medium term. So we should probably react as a Reserve Bank.
Mm-hmm.
But because consumers know about this, because it's predicted, then perhaps it means that consumers will take it into account, which means that it's sort of like.
So they could buy more now.
Yeah, because
So that would add to
plan accordingly. Yeah.
Yep. So that would increase further inflation.
Yes. But
Consumption of like tobacco should be decreasing because New Zealand wants to do like smoke free by 2025.
Mm-hmm.
So we're reaching that year soon. So the government will really be upping programs to try and like discourage smoking. So just kind of over the years, like demand for tobacco will decrease.
If there's a 10% increase on tax on tobacco, that would generate also more revenue for the government, which
Could also
government
decrease
spending.
smoking.
Yeah.
But the question is, what
What-
should the Reserve Bank do, like with monetary policy? But these are all temporary inflation, so we should not change the OCR even. Yeah.
Yeah. So the Reserve Bank shouldn't change the OCR, despite because it's temporary, because it's expected.
Yeah.
So basically what we said is that in terms of the tobacco tax, because it happens every single year, which means that it happens within the medium term, and thus it would increase aggregate demand because tobacco is a substance that's inelastic in demand, which means that if you increase the price of it, consumption expenditure will not decrease. Consumption expenditure will increase relative to price, which means that there will be an increase in inflation. We will tell you that even if this is true, because of government programs enact which would act to decrease smoking because of the government smoke-free policy, which would target smokers and thus would try to lower smoking. So smoking might actually decrease. So and in terms of revenue for government, we would say that because revenue for government will increase because of this tax, we think that would actually lower the government's budget deficit. However, we will not change the OCR because it's expected, because it's or not actually because it's only a one-off thing and it's temporary inflation. Therefore, we won't change the OCR because OCR is dependent on the medium term.
Okay, good. Thank you. You mentioned construction in your presentation, and in the bank's forecasts, construction is growing quite strongly. Can you think of conditions that would limit that growth, and what would be the implications?
So there's a growth in construction, but as Bryna highlighted before, that there's been the construction market is focusing on repairs, right?
Mm-hmm.
Am I right? So it's further straining the construction market, as you said, because they have to handle the housing market as well as focusing on repair and causing capacity pressures over there, right?
So
So that's an inflationary pressure because of increased spending.
a large amount is focused on infrastructure as well. So as we go to new construction.
and aggregate supply is unlikely to increase accordingly because of government policies, which probably would get in, which probably wouldn't target this sort of thing effectively.
Yeah, but the question is, what is limiting the growth of
What's limiting the growth? Right, the earthquakes.
Yeah, like I think.
The Kaikoura earthquakes,
Yeah,
right?
yeah. So I think, like, for example, Christchurch rebuild is coming to like an end. Like most of it's coming to an end. So they like there's less demand for people in construction, so they don't need.
No, there's higher demand because there's demand in Auckland housing market, demand for repairs in Kaikoura,
Yeah, but what is limiting the growth in construction?
Isn't it just the amount of people in the construction sector? So there's always a surplus of jobs, but there's maybe lacking some the amount of people working in the sector to fill each of the jobs.
Yeah, so it's the lack of suitable workers.
Yes. So
And
we have a skill
skilled
deficit in the
workers.
construction market,
Yeah.
which we need to solve as well as. I thought of something, I forgot.
I think there's the Auckland Unitary Plan to increase the amount of housing quickly over the next few years, but it would still be take a while because the amount of construction there is to take priorities.
As well as the cost of the raw materials has also increased, right?
Oh, yeah.
With increased demand, increased demand from the construction firms, and so we have increased cost of production. So that's limiting the growth as well, right?
And the implications of this.
There's also
So like when you said, because the question's asking about the implications as well. So the implications would be there's less supply. So
So
what contribute?
there's bad social flow-ons, which means that people, like first-time buyers, won't be able to buy houses, as well as an increase, like in house prices, because of increased demand, but not of supply not being able to keep up.
Anything else to add?
So that means, with the cost of raw materials increasing as well, so that's also. So the implication of that is that it's going to limit the growth of the construction. Okay. Anything else?
What about like changes in building restrictions? Like after the earthquakes, that's when they found
yes.
out they needed to have new regulations for the buildings. So it's just these like new regulations. Which
Regulations.
Yep. So those also
And
limit
then
growth.
they must get. These regulations will make it more expensive
Yep.
to build a house, and maybe even longer as
Yep.
well.
Yeah, and that limits growth as well.
Yep.
So it's so much. So what we said was that because construction spending is currently increasing, but it's not increasing as much as it could be because of because the Christchurch rebuild is currently coming to an end. The government is spending less money on that, which decreases construction spending because of a lack of skilled workers, especially that can build houses that suit the requirements to build houses, which means that houses aren't being built as quickly as they could be. Additionally, an increase in the cost of raw materials to build houses, which increases cost of production, which means that construction spending really isn't growing as strong, which means that construction really isn't growing as strongly. Also, because the effects of this, the implications of this, like lack of growth, could be that there's an increase in the price of houses due to an increase in demand, but because supply isn't keeping up, that could cause an increase in house prices. Additionally, because this could cause negative social flow-ons as well, because people aren't able to access to houses, which could be a negative implication on society, especially first-time buyers. Also, we tell you that regulations, which make it more expensive and longer, also limit growth.
Okay, thank you.
Great, so now we're going to move on to the inflation targeting framework. So the Reserve Bank employs flexible inflation targeting when making monetary policy decisions. Can you tell us what this means and why it is different from strict inflation targeting?
So I think
flexible targeting, right?
yeah. So obviously, I think it allows flexibility for growth. So if it's too strict, it could limit growth.
Yeah.
Economic. What
It
else?
may also help to think about the PTA when answering this question.
Okay.
Oh yeah, because the PTA only targets the medium term, which is between 1 and 3 years. That allows flexibility in the short term.
Yeah. So it's important to look at that outcome in the medium term.
Also, because the band is like 1 to 3%, it's not just like a set amount, which means that there is flexibility within that band as well.
Flexible targeting of inflation
Like, what does it mean?
would, so it would mean that we can allow our inflation to be maybe below the target band or above the target band.
In the short term.
Yeah, but
Yeah. When they mean flexible,
without strict action, without a quick action of like when you see that your inflation is down below like 0.4 or something, then you straight away decrease the OCR. But
Yeah.
because you must look at the context of the whole economy when
Yeah,
changing
so
your
it
OCR,
allows you
yeah.
to have to allow yourself to be more flexible because it allows you to view the whole economy as a whole and act accordingly instead of just looking at your strict inflation target.
So it allows you to work in anticipation of the future in case that inflation might increase in the future. You can wait for it instead of having to accommodate to fix just the 2% midpoint straight away.
And I think because the economic environment is always changing every day, so it's important to have inflation that is flexible. I mean,
Yeah.
like
and with
OCR that's flexible.
uncertainty, with the
Yeah.
global
Oh, yeah,
uncertainty,
uncertainty.
as well.
So that compares with strict inflation targeting, because strict inflation targeting would look at fixing inflation to a fixed range within the short term, and always keeping within that target.
And we should also put more emphasis on
Cool, are you able to just give us your answer?
Do you want to do it? Okay. So we will say that the PTA agreement, because it's a 1 to 3% target within the medium term, so that allows for accommodation of short-term temporary pressures, like we told you in the presentation, like things like increases in tobacco, increases in food prices temporarily, which might drop out of the equation in the medium term. So it allows flexibility in that regard to accommodate for short-term pressures. It means that growth is not limited because you're more flexible, so you allow for maybe inflation to slightly go above or below in the short term to allow to accommodate for the economy and its growth and its dynamics. It also allows for flexibility within the band, and especially in times of uncertainty like now, when like a global uncertainty like we see in other countries and internationally, like the US and the UK, which might make the OCR and which might make the inflation rate fluctuate within above and below that target band.
Great, thank you. And we've got time for one last quick question. Why does the Reserve Bank publish its forecasts for inflation and interest rates? And why do some other central banks choose not to publish their forecasts?
So when they publish things, they obviously want to influence consumer spending patterns.
Yeah. Through moral suasion.
Yeah, so the use of moral suasion, so they can actually control inflation without actually implementing monetary policy to control it. So they could.
Yeah, also for why we publish it gives transparency to the
Yeah.
Reserve Bank, and that way consumers and the general public would trust the Reserve Bank's decisions more.
Yes. Yeah, and I guess that creates more certainty in the economy with consumers and businesses and investors.
Yeah, and that could fuel better economic growth because consumers believe in the economy and would invest accordingly.
And financial stability in the economy.
Yeah. As well as publishing forecast, you can also say that it's good for the businesses because then the business can plan.
Yeah, it's good for business planning and investor planning.
Yep.
Yeah.
If they can see what's going to happen with inflation.
Yeah.
Yeah.
So why do other countries, why do other banks not publish this?
Helps allow moral suasion.
Sorry?
Helps allow moral suasion to have more effect in some ways.
More
Because they may try to persuade them to move inflation back to the target band, whereas if we do that, we might have other implications, such as people anticipating inflation and they act accordingly, which is not too good.
Yeah. So reasons why other banks don't publish it is because they don't want to, create people to like fuel inflation, or like do the opposite. Any other things?
It could be because of a lack of transparency, because the government might not, the Reserve Bank might be associated with the government and have political objectives.
Yeah, so for political reasons they don't
Yeah.
publish.
Do we have anything else to add? Yeah. So to answer the two questions, firstly, why we publish the forecast for inflation rates, we will say that it's because very often it could influence consumer expenditure, and you could allow consumer and business expenditure to forecast through moral suasion in the medium term. It increases transparency because the consumers and firms know what the government's doing, which increases trust for the economy and the government and the banks. It creates certainty in the economy, and thus it increases financial stability and also investment, because they generally know what the inflation rate, because the Reserve Bank publishes it, and which allows businesses and consumers to plan accordingly. And to answer the second question of why other banks don't publish their forecast for inflation rates, very often it could mean that because they don't want consumers anticipating it and acting accordingly, which could go against the Reserve Bank's objectives, which might affect moral suasion. Very often it could be due to political reasons, because of a Reserve Bank that isn't independent of the government, which could lead to reasons that are objectives to be created that aren't purely political, but are also, not purely economical, but are also political.
Okay, thank you. That comes to the end of the questions. Well done. You can now relax.